Now we're moving on to subsection 2 here. And the key points will be in this one will be the key functions of insurers, market conduct regulations for our actions in the marketplace, type of rating laws that are being used, financial regulation of our industry, rating services. The test always emphasizes insolvency, and the fact that the commissioner can become conservator and take over an insurance company, as well as we'll touch on when they do, because the company's insolvent, the guarantee associations. And we will end it with unfair trade practices, which are known as unfair competition if you're selling, or unfair claims practices if you're in the claims department. Then we will go over the questions for that section. And what will happen here is it's time for you to, once again, look it over, pause, and take the questions. Now that we have done, you've looked it over and you have done your questions, let's go over them. Number 1, it is considered an unfair method of competition for an agent to advertise that the insurer the agent is appointed with is a member of the Guarantee Association. Remember, you cannot use the fact that you're a member or insured against insolvency in sales or advertisement. That always shows up in some format. 2, insurers must submit an accredited financial statement annually to both the state and the NAIC, which is the National Association of Insurance Commissioners. When we report to the state on a quarterly basis, we also report to the NAIC on a quarterly basis. But the accredited one, meaning where an outside source verifies the information, is annually. Now, number 3, most classes of insurance, the rates require what before usage? Well, the answer is prior approval. Definitely true for life and disability and health products. And same for your auto and homeowners. So predominantly used is prior approval, which means we submit for a rate change and either the commissioner approves or disapproves. Now, number 4, insurer examinations and the insurance regulatory information systems are the 2 major sources that insurance regulators use to monitor insurer insolvency. True, meaning insurer examination is the DOI showing up at the insurance company and looking over the books. And insurance regulatory information system is all those reports down for various things such as claims, apps issued, money paid out, money brought in, that are being filed on a quarterly basis. Now 5, if an insurer has enough financial resources only to provide for all its liabilities and for its reinsurance of outstanding risk, it is considered to be, and the answer is insolvent, which means financially unstable. The key word there is, I want you to underline the word only. Only sometimes means, more times than not, incomplete. What is missing is paid in capital. So it has to have enough financial resources to cover 3 things: liabilities, reinsurance, and paid in capital. 6, if an insurer is not able to meet financial obligations when due, it is considered insolvent, which means they're having a cash flow problem. And then your next question, 7, if an individual fails to send the documents when the commissioner issues a notice of seizure, the penalty is $1,000 and or 1 year in jail. Now, though they can storm your agency, I've known one that was done recently, but they can install a big brokerage house or an insurance company. But it means when they come in like the SWAT team, whatever they want, you have to give it to them. Now, 8, besides having enough assets to provide for its liabilities and reinsurance. In order to remain solvent, the insurer must also meet minimum requirements equal to what amount required by the code. And the answer is paid in capital. Now, you can get more than one test question on insolvency, and you can see the 3 or 4 different ways they come up with it, or you can get all of them on the same test. Now 9, directly advising a claimant to obtain the services of an attorney is a violation of unfair practices. That's false. It's telling them not to get an attorney. That would be the violation. 10, the purpose of the California Life and Health Guarantee Association is to protect life policy holders and or insureds when any insurer becomes insolvent. Well, that answer is false because it's life and health policy holders. So it can't be just one because it applies to both of them. Now, your next test question that we're working on would be the penalty for engaging in unfair practice is no more than $5,000 if not willful and no more than $10,000 if willful. That's true. Now, that one usually comes in a scenario. It says the agent has been found guilty of 4 incidents. 2 were not willful, 2 were willful. What would be the fine? $30,000, because the 2 that are not willful is 5 apiece. The 2 that are willful are 10 apiece. So that totals up to 30. Now, if an agent refused to submit their books and records, remember under that summary of seizure, they would be guilty of a misdemeanor. Now 13, if the commissioner revokes the insurer's certificate of authority, they can take possession of the transaction records, confiscate the office premises, or liquidate the business. That's true. In other words, the company became financially unstable and the commissioner got a court order to take over as conservator. So he's basically the CEO. Now 14, commissioner as the conservator can use the guarantee funds to pay salaries to keep the insurer going. That's false, because if you remember, the guarantee funds are to pay claims of insolvent members. Now then, I would, 15, the function of identifying and selling to potential customers would be marketing and sales. That's the division that would be responsible. So I would underline identifying and selling. Then 16, process to decide which customers to insure and for what coverage. That would be the key function of the underwriting department. Now 17, in the in the state of California, a rate will not remain in effect if it is considered to be excessive, unfairly discriminatory, or inadequate. That's true. Now that one, they could put it on a positive, switch it around on you, and simply say for a rate to remain in effect, it must be reasonable, all right, which means not excessive. It would have to be equitable, not unfairly discriminatory, or it would have to be adequate, meaning enough that they don't become insolvent. So make sure you're looking at it, are they asking you it in a positive or a negative? Now 18, the commissioner considers the insurer's investment income when determining if the rates are adequate or excessive, not whether or not the insurer is competitive. The commissioner does not care if we're competitive at all. They just want to make sure we don't become insolvent and we're not price gouging the consumer and we're not discriminating. Now 19, advising clients that an insurer is protected from insolvency by the California Insurance Guarantee Association, or advising clients not to place business with an insurer that deals directly with the public, or not to obtain the services of an attorney, are all violations of unfair practices. If that's not there, it would be unfair methods of competition. Now 20, the state law that regulates insurers' practices regarding underwriting underwriting, sales, rate making, and claims handling would be market conduct regulations. And remember, rate making is the process to determine pricing. That too can show up on your test. Now, the next one is going to be 21, and that is going to be CLHIGA. That's the Guarantee Association for Life Insurance and Health. So it does not handle claims of insolvent members in the classes. Oh, I'm sorry, that's my mistake. CIGA, C-I-G-A, that's going to be the Association for Property and Casualty, does not handle claims of life and health and disability carriers because they have their own guarantee association. Now, the next one, 22, the other association, CLHIGA, stands for California Life and Health Insurance Guarantee Association, where the other one above, CIGA, stands for California Insurance Guarantee Association, and that's property and casualty. 23, CLHIGA, would provide protection for insolvency for employer self-funded plans. False. It only backs up insurers becoming insolvent, not employers who become insolvent. Now, 24, CLHIGA, would provide protection for direct group life insurance. The answer is true. That's an insurance company. And 25, the CLHIGA would provide protection for group stop loss plans. The answer is false. Remember, stop loss plans have to do with self-funding. So we're done with that section.